Hello, this is Haskins, your Forex mentor. Welcome to another phenomenal day in the Forex markets. This is your daily review of February 27th and the preview for February 28th, 2013. Your daily dose of events that shape the Forex markets. We have a very good one for you today. Your thought for the day: a good laugh and a long sleep are the best cures for anything. This is basically an Irish proverb, and I go by it. I like to live my life completely, and I love to rest well. So make sure that you don't become a trading zombie and you chase money so much that you lose sleep over it. Now, I wanted to share with you something which happened today. Well, we had a snowstorm in Canada, and it was a snow day. So my kids were at home with me, and like how it said, when life serves you lemons, make lemonade. When life gives you snow, make a snowman. So I'm glad that I spent some quality time with my children, making some fantastic snowmen, and I hope it lightens up your day. Okay, we had a fantastic trade today on the core durable goods orders. Now, this was another 25 pip winner on USDCAD. I've asked Rick to do the results, video. All our members will have access to that. It is just below the trade plan page. Now, there is a very important lesson out here. The important lesson is that even seasoned traders, they make mistakes. Rick went long on the USD prematurely instead of waiting for the right entry criteria and going short. So if he'd followed the trade plan to the T, this was a 25 pip winner, but he ended up losing money. Um, the moral of the story is, do not jump the gun. Wait for the trade plan to form. Do not try to get in a few pips earlier, hoping that that a breakout is going to occur in this particular USD CAD case when we looked at the core durable goods orders. So it is a very important lesson. I want to share with you our results. Um, we've had a phenomenal month of February, and the total trade plans so far have been 22. We've taken 16 trades. There have been a lot of new, about six no trades. And out of the trades which we've taken, we've won 13. We've lost just three of them. So it's a phenomenal record. We are at 81% win rate. And, if you just gone to 1:1, you would have made phenomenal amount of money. If you had targeted more than 1:1, you would be making close to 415 pips for the month. On an average, though, we're documenting it at about 347 pips for February, which is a phenomenal month. And this reminds me of another question. People often ask me, how many pips do you make? The question is not how many pips do you make, how many pips do I make versus how many pips do I risk. Now my 347 pips might be overshadowed by, let's say, somebody who makes 1,000 pips a month. But if to create those 1,000 pips a month, if he's risking 2,000 pips, it is not a very good system. Out here, the maximum loss you would have gone if you'd taken all the trades and if they'd gone against you would have been 80 pips. So just a little something out here. We've had this results page. You can have a look at it, and the idea of the results page is to keep you updated with which are the trade plans which are working and which are not. Another thing about the core durable goods, though this time the core durable goods work, I've changed the trade plan, and over the weekend I'll have myself or somebody uh, record the trade plan, the new trade plan, and have it available. Now, there's some important news. One of the most important news which we got today was the Italian 10-year bond auction. Let me share that with you really quick. If you look out here at 5:12 a.m., this wasn't a trading event, but it is very important. Why is it very important? Because look at this number out here. We had the yield at 4.83%, and the last time the yield was 4.17%. Now, why is this so important? Is because Italy is going through a leadership crisis right now, a government crisis, and that's one of the reasons why euro had fallen tremendously. Now, uh, the bonds, when they are issued from Italy, if they had a yield of over 5%, that means the bonds, when they are auctioned out, there is no fixed price at which that they'll be auctioned out. The market decides the yield, and the higher the yield, that means that eh, the more scared the market is of them getting the money back. So because of that, they want a higher interest. So the number to watch out for is 5. If any European nation goes above 5, that means that the market is basically um, asking for a lot of yield from that government, and it becomes more and more difficult for it to sustain. So though you can see that from last time to this time, there has been a decent increase in the yield, which basically means that the public is a little more scared, but it is not over 5 percentage points. So that's something which you need to bear in mind. That's about it. And the orders for US non-transport durable goods jumped most in a year. Now, orders for the US durable goods, excluding transportation gear, climbed in January by the most in a year. This indicated that business investments is holding up. You need to weave a story out here. Remember yesterday I told you about the new home sales, the highest they had ever been. Now I'm telling you that the US durable goods sales are the highest that they ever have been over the last 1 year. Now, bookings for equipment meant to last for at least 3 years, minus demands for such things such as aircraft, which is often volatile, climbed 1.9%, which is basically the core durable goods sales. Now, this exceeded the forecast of economists surveyed by Bloomberg by the most amount since December 2011. The Commerce Department data showed that um, the economy is very vibrant, and the total orders dropped more than projected, reflecting the biggest slump in defense booking in a decade. So the defense booking was bad, but the economy is actually picking up, which is good for risk appetite sentiment. Now, another thing, the January home sales up in all regions. Let's look into that in detail. Okay, January's pending home sales up in all regions. See, we are weaving a story. What is the story? Yesterday, we had the new home sales, which was phenomenal. We had the durable goods sales, which was phenomenal. And we have the pending home sales all up in all regions. Pending home sales rose in January and have been above year ago levels for the past 21 months. Now, according to the NAR, the Realtors Association, basically, they were um, they were healthy monthly gains in all regions but the West, which is constrained by limited inventory, but was slightly improved. The pending home sales index, a forward-looking indicator based on contract signings, increased 4.5% to 105.9 in January from a downwardly revised 101.3 in December, and is 9.5% above January 2012 when it was 96.7. The data reflected contracts but not closings. The January index is the highest reading since April of last year. So the housing market is booming, the durable goods market is doing very well. Now, Feds will stick to its bond buying program, Bernanke says. The Federal Reserve plans to continue to buy bonds at its current pace. Ben Bernanke said in a testimony to the US Senate Banking Committee. Now, the Fed's stimulus efforts aren't creating asset bubbles, in his opinion, or raising the risk of inflation. That's again in his opinion. We do not see the potential cost of increasing risk taking in some financial markets as outweighing the benefits of prompting a stronger economic recovery. Now, um, well, basically, uh, why is this testimony important? Because remember, a few days ago we had a few of the governors from the Federal Reserve uh, point towards inflation and not growth. This was the first time in in a few months that the governors expressly said that they are a bit concerned that inflation might kick in, and they may want to uh, do away with this easy money policy for sooner than expected, and that caused a little bit of jitter in the market. So now the big boss, which is Bernanke, says that don't worry, market. I'm going to keep on printing as much as money as needed. You don't worry at all, and you can invest all you want in the stock markets. Why is uh, uh, what is the reason why they're buying bonds? Because they don't want the yield of the bonds to go up. If the yield of the bond goes up, that means that like in the case I told you about Italy, we wanted the yield of the bond to remain low. If the yield remains low, that means that the stock markets are yet vibrant. So that is what Bernanke wants to do, and they are throwing everything which they have to keep, increasing stock market prices. Now, another good question. I'll have some more information on Bernanke a little bit later, but another interesting news article was Russian banks diversifying. Now, the Russian banks are diversifying sources of capital and savings on interest expense by going into offshore yuan bond markets. They're basically going to China. Bond buyers have a strong appetite for such bonds because they offer exposure to China's currency, they deliver attractive yields, and are issued by prominent banks that have the backing from the Russian government. What what does this mean? It means that if you want to play in the bond market, maybe you could look into China bonds because of the attractiveness of the yield as well as an exposure to the yuan. Now, this is something which is very interesting and it kind of baffled me a little bit. It's the first time I'm seeing something like this. Bank of England weighs negative rate to boost small business. Uh, right now, the rate in the United Kingdom is 0.5%, which is so close to zero. But the Bank of England is considering a special negative interest rate for transactions between the central bank and the commercial banks to encourage small business lending. So it's now for keeping money, they actually pay you to take money instead of charging you an interest for taking money. They're considering, okay, I'll give you money to take your money, to take money. This is something crazy which has come up, and I just wanted to share this out with you all. You need to be abreast about this. The If this particular policy kicks in, we could see the pound fall significantly. But this is not something which is happening. This is a thought which has been floating. Now, I told you I had something else with Bernanke in mind. Now, the world's most influential beard has risen to new heights of stardom. Bernanke is number one on Twitter. This is phenomenal. And the sequester, which I was talking about, was even hotter than the Oscars yesterday on Google Trends. So the finance. Now, why do I look at social media? Because I want to know whether a particular topic is of interest to people, so that whether that would have an impact on my trading or not. Now, I've always maintained that sequester is something which you'll listen to a lot this particular week, and that's indeed what the majority of the world's citizens on Google are talking about. Imagine a topic of sequester being hotter than that of Oscars. A year ago it would be unthinkable, but this is true right now. Now, now, why is this such a redundant topic? Uh, Everyone's talking about the sequester, and if the sequester kicks in, we should have a huge increase in the value of the US dollar and a fall in the stock markets, and all the mumbo jumbo which comes along with it. But if nothing is done by Friday and the sequester kicks in, the federal government will yet spend a total of 3.553 trillion in the fiscal year of 2013. That is 15 billion more than that of 2012. So the sequester basically talks about cutting the rate of increases. There's On the ground there is no real cuts, and they're making it such a huge big deal. A lot of it is coming from social programs. A lot of it is coming from defense budget. In my own humble opinion, they need to bite the bullet, and perhaps this will be the only way in which they might be able to put their finance back in order. USA does not have to spend as much money as it does on military and on social benefit programs, because they don't have the money to spend. But that's just my opinion, and take it for what that is worth. I'm not interested in my opinion. I'm interested in what's going to happen if certain events occur in the financial market. So talks are still going on, and Friday will be the day to look at. Now, the preview for tomorrow. As I stated earlier in the week, on Thursday, that is the 28th at 1:45, I'm going to be watching the Swiss GDP just to record the release and the movement of the Swiss franc. I don't have a trade plan for that, but something is brewing for sure. And at 8:30, we have the US GDP. This GDP is a follow-up to the advanced release, which was last month, which was on the January 25th. Now, there are three versions of the GDP release a month apart: advanced, preliminary, and final. The advanced release is the earliest, Basically, it was the one which was released last month and tends to have the most impact. Again, there is a possibility of a spike trade in the US GDP, but I'm not going to be looking at that. I'm going to be, I'm just going to be noting the way the markets react. I am not going to be trading it. Now, because of the US GDP, this week's initial jobless claims at 8:30 will be a no-go because the US GDP will outweigh this release. So thank you so much for watching this phenomenal review and preview. Please reply back and tell me how do you like it and any changes you want me to incorporate. Thank you. Have a great day. Bye for now.